Next, a hearing on the growth of virtual currencies and the markets they are traded in. A panel of lawyers appeared before the House Financial Services Subcommittee on Capital Markets, Securities and Investment. Topics included consumer protections, transparency, and federal oversight of the industry. This is 2 hours and 10 minutes.
And without objection, the chair is authorized to declare a recess of the committee at any time. The hearing is entitled Examining Cryptocurrencies and ICO Markets. I now recognize myself for 4 minutes to give an opening statement. The cryptocurrency and initial coin offering markets have grown rapidly in recent years, and actually that's more like recent months. Specifically, ICOs have been increasingly used by companies to raise capital for their businesses and products. To that end, people often equate them with a new type of initial public offering, or an IPO. However, an ICO is not an IPO. ICOs, whether they represent offerings of securities or not, offer potential for entrepreneurs to raise more effective, transformative, and efficient funding for innovative projects as opposed to a traditional IPO. Although an ICO has the same characteristics of raising capital and accessing new sources of investment, it does not involve an investment in some amount of equity in a company, which is afforded under an IPO, nor does it offer the same amount of investor protections. The size of the ICO market has grown exponentially in this past year, and the Token report estimates that approximately $6.6 billion was raised in coin offerings. In 2018 alone, just in the first few months, 480 ICOs are estimated to have raised $1.66 billion. Cryptocurrencies and ICOs provide an innovative vehicle for startups to potentially access capital and grow their businesses. Early investors in some cryptocurrencies have experienced massive gains, and an ever-increasing number of ICOs has created opportunities for investors to diversify their portfolios in cryptocurrencies. Since this surge in popularity, or crypto craze, there has been considerable attention attracted both by investors seeking to diversify their portfolios and startup enterprises in search of additional access to capital and to grow their businesses. This has also rightly garnered the attention of the regulators. Additional scrutiny has surrounded the cryptocurrency and IPO markets due to the number of fraudulent IPOs that have raised money with no intention of ever providing a product or a return to the ICO purchasers. A soon-to-be-published MIT study of the ICO market estimates that $270 million to $317 million of the money raised by coin offerings has, quote, likely gone to fraud or scams, end quote, according to MIT professor Christian Catalani. The SEC has the authority to bring enforcement actions against ICOs for any violation of the federal securities laws. As part of this increased scrutiny of the ICOs, the SEC recently announced actions against 2 virtual currency organizations for engaging in unregistered securities offering. Additionally, the SEC suspended trading in 3 issuers claiming involvement in cryptocurrency and blockchain technology. The Wall Street Journal also recently reported that the SEC has issued, quote, dozens of subpoenas and information requests to technology companies and advisors involved in ICOs, close quote, including, quote, demands for information about the structure for sales and pre-sales of the ICOs, close quote. Further, on March 7 of this year, the SEC broadened its series of notice statements to exchange-type activity, warning that online trading platforms may also be violating the federal securities laws. According to the statement, if a platform is providing a mechanism for trading assets that are classified as securities under the federal securities laws, then the platform is operating as an exchange and must register with the SEC as a national securities exchange. Today's hearing will examine the economic efficiencies and potential capital formation opportunities that cryptocurrencies and ICOs potentially offer to businesses and investors, and review the adherence to applicable laws so that investors receive the full protections afforded by the federal securities laws. Additionally, the hearing will consider the current regulatory approach that regulators, such as the SEC, are using to monitor and oversee cryptocurrencies and ICOs, and how to achieve further regulatory clarity in these markets. As further action on how to regulate cryptocurrency and ICO markets is considered, it's important that innovation in the area of digital currencies and capital formation are not stifled while ensuring that consumers are protected, fraud is prevented, and securities laws are followed. The Chair now recognizes the gentleman from Minnesota, Mr. Ellison, for 2.5 minutes for an opening statement.
Mr. Chairman, thank you for calling this important hearing today. As important as it is, there are some other things happening that I want to address. The Senate is voting today to roll back some of the rules for the biggest banks in the country. Think about that for a minute. Just 10 years after big banks crashed the economy, Senate Republicans and some Dems want to roll back the rules that we put in place to prevent the next crash. Some of my colleagues may have forgotten about how bad the crash was, but I haven't. Millions of people lost their jobs. 1 in 54 homes was in foreclosure. $2.6 trillion vanished from Americans' retirement accounts. So why on earth are we going back there? Supporters of the bill say this is just about helping out the small community banks. No, not buying it. Community banks are doing pretty well. We're not saying they don't need some attention, but this is not about them. The FDIC says that 96% of them are profitable, and these profits are higher than ever. Again, I want to be attentive and responsive to community banks, but this is not about the small banks. The banks that are going to benefit here, these are banks that got close to $50 billion in bailout money during the crisis, and banks that can put their name on a football stadium. Some of these provisions in this bill roll back the rules for the very largest banks like Citigroup and JP Morgan Chase. This bill increases the chance of another crash, and the nonpartisan Congressional Budget Office says the bill will increase the likelihood of another bailout. I'm disappointed that the Senate is likely to pass this bill today, and I can promise this committee that I'll do everything in my power to stop it when it comes over to the House. And I yield back. Thank you.
The gentleman yields back. The gentleman from Illinois, the Vice Chairman of the committee, Mr. Hultgren, is recognized for 1 minute.
Thanks, Chairman Huizenga. Thank you all for being here. According to coinmarketcap.com, there are over 1,500 different cryptocurrencies with the total market capitalization estimated to exceed $350 billion. It's a staggering amount of money. As this market develops, Congress has a responsibility to ensure that investors are protected without unduly limiting opportunities for growth. Some of our most respected technology companies have expressed at least some uncertainty regarding cryptocurrencies. This is a complicated topic. For example, Google just announced it's banning ads promoting cryptocurrencies, exchanges, wallets, initial coin offerings, and firms providing advice. Congress needs a strong understanding of the technology and its application before we can understand how it fits into our existing regulations and how the laws we have on the books may encourage or inhibit an efficient market. For example, do we need clarification of what a cryptocurrency exchange is and if this word implies any investor protections? The SEC staff made this point the other day when noting, and I quote, "Many online trading platforms appear to investors as SEC registered and regulated marketplaces when they are not," end quote. Similarly, Chairman Clayton has expressed skepticism about no initial coin offerings being registered. So there are a lot of questions in this. I think it's important that we're having this hearing today. My time's expired and I yield back.
Gentleman's time has expired. The Chair now recognizes the gentleman from California, Mr. Sherman, for 2.5 minutes.
Unfortunately, our colleague, distinguished ranking member, was unable to be here this morning. Ask unanimous consent to enter into the record the statement of the gentlelady from New York.
Without objection.
Cryptocurrencies are a crock. What social benefit do they provide? Well, they allow a few dozen men in my district to sit in their pajamas on the couch all day and tell their wives they're going to be millionaires. They help terrorists and criminals move money around the world. They help tax evaders. They help startup companies commit fraud, take the money, and 1% of the time they actually create a useful business. But then again, I dare say that some tiny percent of all larceny and crime helps finance something that turns out to be useful. It hurts the U.S. government in two ways. Our ability to have the dollar be the chief means of international finance is what has underpinned our ability to impose sanctions and stop tax cheating. And furthermore, when we have people take risk, we don't encourage gambling. We encourage investment in the real economy. But when you buy a Bitcoin, are you financing a new factory? No. You're gambling on its value for no social benefit. Now, I know that these cryptocurrencies are popular. They're popular with guys who want to sit in their pajamas and tell their wives they're going to be millionaires. And they're popular with those who have read Atlas Shrugged and Fountainhead and believe that these are the new canons, the new divinely inspired documents of our age. But they're harmful, and they're harmful in one other way, and that is, and I'm going to mispronounce the word, sinnerage is the benefit that the U.S. government gets by issuing currency. It is the float. It is the fact that we do not pay interest on newly created dollars. We lose that as well. And the Fed is able to return well over $50 billion to our Treasury in many of the recent years. We undercut that. And then finally, we've got these initial coin offerings deliberately naming themselves to lie to the public and convey the image that it's like an initial public offering. They stole the intellectual property and trademark of legitimate investing and applied it to a fixed, fraudulent gambling scheme of no social benefit. Aside from that, I think it's a good idea. I yield back.
Gentleman yields back. And gentlemen on our panel, you are in for a lively conversation. No, this is not a Senate hearing about Dodd-Frank reform. You are in the right place. We are here to talk about cryptocurrencies and blockchain technologies. But we are here to welcome today a great panel, Mr. Mike Lemp, who is the Chief Legal and Risk Officer for Coinbase, Dr. Chris Brummer, who is a professor of law from Georgetown University Law Center, Mr. Robert Rosenbloom, partner at Wilson, Sonsini, Goodrich, and Rosati, and Peter Van Valkenburg, Director of Research for Coin Center. So each of you will be recognized for 5 minutes to give a oral presentation of your testimony. Having read the testimony, there's far more than 5 minutes of information in each one of yours. So good luck as you consolidate that down. But we will then have a question period, and we will, without objection, put your written testimony into the permanent record and part of the record as well. So with that, Mr. Lemp, you are recognized for 5 minutes.
Thank you. And good morning, Chairman Huizenga, Ranking Member Maloney, and members of the subcommittee. Thank you for the opportunity to address this important topic at a significant time. My name is Mike Lemp, and I am the Chief Legal and Risk Officer at Coinbase, the nation's leading digital currency exchange and wallet service. I commend you for holding this hearing on a technology that could transform capital formation, innovation, and our economy. It has tremendous potential. To fulfill that potential, we believe that responsible regulation is required, but the technology's incredible benefits could also be stifled by regulatory or legal missteps. I am pleased to testify this morning on behalf of Coinbase. We view ourselves as a leader in the legitimization and maturation of the crypto economy. We provide an on-ramp for acquiring, trading, and holding digital currencies. Through our strategy of operating the most trusted and easiest to use digital currency exchange and wallet, we have grown dramatically. We have very strong cybersecurity protections and compliance practices to ensure that we remain the most trusted company in this space. Our cybersecurity program is state-of-the-art and remains the critical core of our business. Similarly, our compliance program is designed to build upon the highest levels of compliance in our industry. In addition to our formal regulatory role, Coinbase continuously shares its expertise to make sure that our ecosystem is clean and compliant. We train more law enforcement agencies globally than anyone. I plan to discuss 3 items today: the model of the Coinbase Exchange, our view on ICOs, and the broader regulatory environment. Coinbase Exchange operates a spot exchange that offers the ability to buy and sell 4 digital currencies. We do not offer margin or derivatives trading. There are more than 1,400 currencies and tokens available, and we limit our trading to 4 that have regulatory clarity: Bitcoin, Ether, Litecoin, and Bitcoin Cash. Part of the reason we trade only those 4 assets is that each has been determined by regulators to be a virtual currency, and therefore, we believe, not a security. One of today's questions is how to approach ICOs. Coinbase currently does not trade ICOs or any other security tokens. Despite that, we believe that ICOs are inevitable and full of tremendous potential. We believe they can unlock the ability of entrepreneurs anywhere in the United States to raise money on a level playing field. Entrepreneurs won't need to know funders in Silicon Valley or New York to access vibrant sources of capital. At the same time, there is a need for responsible regulation to ensure investor protection. We welcome that regulation. In order to fully enable ICOs, investors must have confidence in the integrity of the market. For this reason, we support enforcement actions where they are necessary to weed out bad actors and to protect investors. At the same time, we need to be sure that we are not chilling good innovation brought about by new technology and good actors. We believe there is no need for Congress to create a new regulator or a new regulatory scheme because federal regulators already have sufficient authority to oversee this space effectively. There are at least 4 federal regulatory agencies that can effectively protect investors and the markets: the SEC, the CFTC, FinCEN, and the Federal Trade Commission. In addition, this federal regulatory regime exists alongside vibrant state regulations. With respect to the U.S. regulatory environment, it is important to stress that not all tokens are alike, and regulators need to be able to distinguish between various tokens to enable innovation. This requires regulators to coordinate and provide clear guidance to market participants. For example, some tokens may be a commodity and others a security. The SEC and CFTC should be able to draw a line to determine whether a token should be treated as a commodity or a security for compliance purposes. The agencies have done this before when new asset classes emerge. For example, in addressing stock indices and swaps. As mentioned in the beginning, we operate the most trusted and easiest to use platform to access digital currencies. We believe that trust is enhanced through partnership with regulators. At Coinbase, we are committed to working with you, the SEC, the CFTC, and other regulators to help shape a responsibly regulated market. We believe the decisions you are making now will help determine the future of innovation and capital formation. That future is not 20 years away. It's almost here today. Thank you for this opportunity to discuss these issues, and I look forward to answering your questions.
Thank you. With that, we go to Dr. Brummer, who is recognized for 5 minutes.
Chairman Huizenga, members of the subcommittee.
If you can push the button in front of you, there we go. Thanks. And pull that mic down in front of you. There we go.
Thank you so much for inviting me here to testify at this hearing. My name is Chris Brummer, and I'm the Agnes and Williams Research Professor at Georgetown University Law Center. And I'm here today solely in my capacity as an academic, and I'm not testifying on behalf of any entity. We are blessed in the United States to have one of the safest, deepest, and most liquid capital markets in the world. One of the reasons for this success is our system of information sharing and dissemination to investors. The disclosure system embodied in the Securities Act of 1933 is largely one where promoters share, among other things, material information publicly about their company, management, and the securities being offered, as well as the intended use of the proceeds. This information is then filed with the Securities and Exchange Commission, where it is vetted, scrubbed, and analyzed. Most ICO disclosures, by contrast, are facilitated by unregulated white papers, focusing largely on the existing technology or technology under development to be financed via an offering. There is, as a result, a large gap between the disclosures and many of the registered filings, such as an S1, and the information provided in most white papers. And this raises a number of red flags, to say the least. For our purposes today, I would like to highlight briefly some of the key disclosures one would expect and likely need in order for buyers of ICO tokens, whether they are investors seeking to profit or technology users seeking to support and participate in an innovative product, in order to make a purchase in an informed manner. These disclosures are relevant, especially relevant, I believe, as ICOs transition from technical expert ecosystems to the distribution of instruments that are ever more likely to attract everyday investors and the retail public. Disclosure number 1, a promoter's location. At least one study has noted that in roughly 32% of ICOs, it is not possible to identify the issuing entity's or promoter's origin. This creates serious information asymmetries on the part of the investor. Without knowing the issuing entity's or promoter's origins, it becomes impossible to know or identify what rules and legal protections might be afforded to investors. Further, investors have few means by which to contact relevant public authorities in the case of fraud, theft, or loss. ICO white papers should therefore set out a detailed statement beyond a simple PO box of what the issuer as well as its key, of where the issuer as well as its key management are located. Disclosure number 2, problem and proposed technology solution. For most of the history of U.S. securities law, no information was more important for investors than an issuer's financial statements. But ICOs tend to serve a different purpose from IPOs of the 1930s. Instead of funding industrial companies transitioning to a more mature cycle of development, ICOs involve products developed by startups identifying technology-based problems and proposing the sale or financing of technology-based solutions. And in return for financing, promoters offer coins with varying currency, utility, or securities features. For most of these offerings, as a rule, is not the company's past performance or even financial statements that is most important. Instead, it is the venture's technology proposition. Consequently, ensuring that investors, including retail buyers, understand the basic contours of the underlying technology solution is paramount as ICOs become more popular means of fundraising. To that end, you can envision a number of important reforms. An optimal disclosure system for IPOs would require, to the extent possible, a plain English description of the technology problem and solution. Furthermore, for larger fundraisers, more technical parts of the white paper would ideally be subject to a system of third-party validation, what could be termed a technology audit. And meanwhile, all code, regardless of the size of the fundraise, would be posted to a public code repository such as GitHub, so potential buyers can either diligence the code itself or other proxies for the strength of the code. Promoters should avoid hyperbole when describing their solutions, an endemic problem in many white papers, and should be required to identify an objective basis for all forward-looking statements. Along these lines, disclosures should be made as to whether post-ICO financial statements will be provided to token holders. A description of the token is also useful. Promoters should be able to disclose whether or not and how the IP ownership of the company's protocol, as well as to detail with specificity what legal rights holders of the tokens will enjoy, as well as how the tokens will be traded and on what system. They should also be required to provide disclosures for blockchain governance and the basic risk factors impacting not only the token itself, but the industry at large. Thank you.
Thank you. Mr. Rosenbloom, you are recognized for 5 minutes.
Chairman Huizenga, honorable members, first of all, let me thank all of you for holding this hearing. I think it is timely. I think it is very, very important. And I think many people in the industry, those who want to get things right, will very much welcome your participation and your interest in the topic. So again, thank you for holding the hearing.
Do you mind pulling your mic a little closer? Thank you.
Absolutely.
Yep,
you know,
perfect.
Normally people don't have trouble hearing me, so this is a lovely change. I am a partner at the law firm of Wilson Sonsini, Goodrich & Rosati, a Palo Alto law firm that is generally recognized as being a leading advisor to technology firms, to life sciences firms, and the like. I am the head of the firm's blockchain and cryptocurrency practice. Now, I do need to say that I'm appearing here on my own behalf, not on behalf of my law firm, not on behalf of any clients. However, thank you for having me anyway. In our capacity as being among, if not the leading tech firm, we obviously handle a great number of initial coin offering and similar transactions. We represent a large number of ICO issuers. We represent a large number of funds that invest in initial coin offerings. We represent a large number of entities, often very sophisticated entities, that are investing in initial coin offerings. I will give you a quick observation that when about 9 months ago or so, the ICO market really started to become significant in the United States, I was concerned, as some of the comments we've already heard, as to whether there was really a there there. As I'll talk about in a couple of moments, I think there really are some very important things happening in this market, and again, I think that's why it's so important for this committee, the subcommittee, to be focusing on these issues. I actually have two basic proposals, or two basic suggestions for this subcommittee. First, I think in the near term, Congress could greatly help the markets, the ICO markets, to facilitate good ICOs and to help guard against fraud by authorizing the SEC, by both authorizing and encouraging the SEC and other appropriate federal regulators to both modify and amend their rules to more closely or assist, or to better assist ICO issuers in meeting the requirements of the federal securities laws. As Dr. Brummer says, there are already a number of disclosure issues. There are already a number of registration requirements to securities issuers. They don't work well. They're not geared towards ICOs into tokens. And so the SEC can be doing a lot more. Although they're trying very hard, they can do a lot more to amend their rules and modify their rules, and I think this committee can help. I think in the longer term, this committee can lead the way towards having a more unified disclosure approach, registration approach, overall legislative approach to how we handle ICOs and token use in the United States. Truthfully, I think it's too early to know exactly what the contours of that legislation are going to look like at this point. Again, we're only 9 months in, really, to ICOs. The industry is so dynamic and changing so quickly that I think it would be premature at this point to try to actually craft that legislation. But I do think that there are basic principles that can help us inform what that legislation will look like when you're able to get to it. I think there are three things, though, that in all of your legislative activities that we should be keeping in mind. One is there is tremendous innovation in the blockchain and cryptocurrency community. And by the way, cryptocurrency is a bit of a misnomer. There are some tokens, Bitcoin, Ether, for example, that really are cryptocurrencies. There are a number of other tokens, and those are most of those that we'll probably be talking about today, that have very specific purposes on very specific platforms designed to do very special things. Second, there are tremendous capital raising techniques, and I hope during this hearing we'll be able to discuss why those capital raising techniques or opportunities are so significant and potentially so valuable to the U.S. economy. Third, there is no getting around the fact that there is significant fraud, significant opportunities for market manipulation, significant opportunities for loss of privacy and data breaches. And those need to be part of and considered in any regulatory and legislative response. With that, let me end my remarks, and thank you so much.
Thank you. Mr. Van Valkenburg, you are recognized for 5 minutes.
Thank you, Chairman Huizenga and members of the committee. I'm Peter Van Valkenburg, Director of Research at Coin Center, an independent nonprofit that's focused on the cryptocurrency public policy space. Today, I'll start by describing the fundamental innovation of Bitcoin, then discuss the differences between cryptocurrencies and ICOs, and finally describe the regulatory landscape for these technologies. The fundamental innovation of Bitcoin is digital scarcity. So in the physical world, you know a thing like gold is scarce because you can hold it in your hand. You can ask a lab to tell you that it's real, and when you hand it to somebody else, they have it and you don't. But in the digital world, how can we know that a Bitcoin is scarce? We know there are only 16.9 million Bitcoins in the world right now because their distribution and movements are described with perfect accuracy on a public ledger called the Bitcoin blockchain. Anyone can independently read and mathematically authenticate the data in the blockchain, just like anyone can independently verify the scarcity of gold. Now, that digital scarcity can then be employed by innovative people for a variety of innovative purposes. A token that is scarce and transferable from person to person can be used as money, just like any other portable and transferable good throughout history, from gold to seashells. That, in a nutshell, is Bitcoin. But a scarce token can also be automatically redeemable for a digital good or computing service provided by the same network of participants who verify the blockchain. And these are projects like Ethereum, Filecoin, and Blockstack, and they are beginning to compete with incumbent service providers like Amazon, Facebook, and Google. A scarce token can also represent a legal agreement or a financial asset. So a public company or investment fund could issue and track its shares as tokens on a blockchain. Now, these blockchains are just records, whether they're about money, assets, or computation, but rather than relying on a handful of corporations running vulnerable data centers to keep the record, a blockchain version of the record relies on an open network of thousands, potentially millions of participants who have skin in the game and independently verify and secure that data. Those records will always be available until every last participant goes offline. In other words, they'll likely always be available. And those records will be accurate unless every participant has their individual computer hacked. In other words, they'll likely always be accurate. It's this revolutionary decentralized architecture that makes these systems effectively unhackable, at least using traditional methods of attack. Especially pertinent to today's hearing, these technologies are also employed for capital formation. Scarce tokens like Bitcoin and Ether already exist in the world, and they are in use. But other coins and tokens are merely theoretical because the software that will enable them has yet to be designed and built. Recently, various developers have raised money to fund the development of new blockchain software projects by selling a promise of future tokens to willing investors in so-called initial coin offerings, or ICOs. From a regulatory standpoint, there is a fundamental distinction that must be made between, on the one hand, scarce tokens that exist on a blockchain and are used for payment or to obtain computing services, and on the other hand, promises of future tokens representing the hopefully profitable efforts of a developer. The former, things like Bitcoin and Ethereum, they are effectively digital commodities. They're scarce items that may have value on open markets as money, as investments, or as inputs for valuable commercial and industrial processes. They're commodities, just digital. The latter, promises of future tokens, are securities. Promises from issuers to investors that efforts will be put forward to create profits. Now, both have investor protection risks, but they are distinct risks that are best addressed in different ways. A commodity-like token has no issuers upon whom investors rely, but the token does trade on speculative commodities markets. Policing these markets for fraud and manipulation is critical for investor protection. A promise of future tokens is a security with an issuer upon whom investors rely. Mandating accurate disclosure from these issuers is, as we've said, critical for investor protection. So the sensible and emerging investor protection regime is nothing new, even though the underlying assets may seem like science fiction. The CFTC should use its existing authority to police commodities, spot markets for fraud and manipulation, and the SEC should manage and mandate disclosure from issuers making securities offerings. But if policymakers get the line between commodity tokens and securities offerings wrong, or if it isn't made clear by regulators, it will destroy the viability of these innovations and cede leadership in this technology to the rest of the world. Thank you, and I look forward to your questions.
Thank you, and I appreciate all of your input. We're going to start with a 5-minute question period for myself. I recognize myself here. I want to try to cover a couple of quick things. Investor protections, first and foremost, the SEC versus the CFTC, and then sort of use of blockchain technology. So on that investor protections part, maybe Dr. Brummer, you could illuminate us here a little bit on what current protections you see or lack of current protections that are in place to really protect Mr. and Mrs. 401k. I mean, that is what, you know, we've got institutional investors, sophisticated investors, and then we've got more retail investors. And so if you could address that quickly. With your mic on and down towards your mouth, please.
Like Mr. Rosenbloom, it's very rare that I'm asked to speak louder. At this point in time, the SEC is working on really operationalizing some of its own powers and authority under the 33 Act, 34 Act, and the 40 Act for the mom and pops, for the investors who are increasingly having exposure to cryptocurrency markets, for the better in some instances and for ill in others. There is a regulatory vacuum currently. That regulatory vacuum extends to some extent to the spot market in cryptocurrencies. I think that where there is or are financial products that under traditional analyses would tend to be identified as commodities, there are questions about disclosure that are required to be asked. I think that even in the securities law space, the infrastructure on which many of these tokens are currently being traded are not entirely subject to the SEC's oversight. So there are rules, there are in place, but it's a mishmash.
I'm going to get to Mr. Rosenbloom here because you had said, well, here's how I encapsulated it here. The SEC is trying to do its job to protect investors, and you say it needs to modify their rules to help facilitate ICOs, yet you say it's premature to draft legislation. Now, both Chairman Clayton and Giancarlo have said, along with their counterparts from the Department of Treasury and Federal Reserve and others, that they may come to Congress here in the coming months. And we know that this has moved very quickly. In the last 9-10 months, we've seen this explosion of it. This panel, this Congress, is not going to sit by idly with a lack of protection for investors. And you've heard some of my colleagues express some, shall we say, skepticism of the legitimacy of cryptocurrencies and certainly ICOs. So I want to look at very quickly what the role for Congress may be to play in this and what chilling effect it may have, from your opinion, quickly.
Yes, thank you, sir. First, I think that there are two parts of the legislation, right? I think there's an immediate set of legislation that needs to happen to authorize the SEC and other regulators to amend, modify rules consistent with investor protection, but also to facilitate capital development or capital investment. That's not to say that there won't also be additional grants of power or additional protections that Congress adds. But what my other point is, this industry is moving so very rapidly. It is very difficult to know. Here, as one example, if you take blockchain, which has a tremendous capacity to store, record, and obtain information, and you mix that with artificial intelligence, which is certainly something people are trying to do today, right? The capacity of artificial intelligence combined with the blockchain to potentially lead to tremendous new marketing, tremendous new business opportunities, tremendous scientific and sociological advances is tremendous. However, the opportunity to advance, or to also use that same technology for manipulative conduct, for data breach, and for all sorts of other, what I'll refer to as nefarious conduct, is really hard to predict right now. And so what I don't want to do is lock us into a system too early. And I'll give you one more.
And I don't disagree, and unfortunately I'm running out of time. And we'll be able to hopefully explore this with some other questions. And Mr. Lemp, I'd like to get to you very quickly. Do you believe that there are any instances where initial coin offering should not be regulated as an offering of securities?
Thank you for the question. It's difficult to answer because it's hard to imagine all the circumstances under which ICOs might be offered. I think that, again, speaking on behalf of Coinbase, we clearly we do not support any initial coin offerings at the current time because we're not sure what the regulatory structure is and regulatory treatment is, the appropriate
treatment. In your written testimony, you talked about the CFTC quite a bit, the SEC not so much, and I have had some express that they believe the CFTC has been more flexible and open and receptive to ICOs and blockchain. I don't know if that's been your experience as you viewed it.
Yeah, I've got to say, our experience is we are waiting for the dust to settle between the CFTC and the SEC before we will actively engage in supporting ICOs.
Okay.
And once the rules are clear, we'll move in. We think tremendous potential. We want to be there to support it. I will say that there is an important distinction between what is a security and what is a commodity. They perform different functions, and they do deserve to be treated differently.
Yep. Well, I'm well over my time. There is no doubt, though, a token is not gold and a commodity as such. So I think that's some of the struggle that we have. So with that, the chair recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you, Mr. Chairman. And Chairman Huizenga, you have opened up a line of discussion here that I'd like to follow up on. Mr. Limmers, in your testimony, you said that you believe there is no need for Congress to create a new regulatory regime. You've said you felt that the federal authorities already had that authority and that it was basically just a lack of coordination. But Mr. Limmer, both the SEC's Chairman Clayton and the CFTC Chairman Giancarlo have told me that neither one of them, nor the SEC or the CFTC, have any regulatory authority. And as a matter of fact, they said what regulation there is at the state level. And on top of that, at the state level, they are regulating these entities as what they refer to as money transmitters. So it just seems like to me that there is some type of regulatory shortfall here. And if you ask me, it's a little bit of that and not just a lack of coordination. So you see my point there?
Yes, Congressman, thank you. I do. And what I would say is that there are sufficient authorities in place today. And I'll point out that there is a long
So you're saying that the chairman of the SEC and the chairman of the CFTC are wrong? They say that that's not so.
No, what I'm saying, though, is I think in context, what's happening is when you talk about money transmission licenses, that covers a portion of our activity as a business. We're in many ways an integrated business, a portion of which is licensed by the states for money transmission purposes.
Yeah, but it's done at the state level. There is none at the federal level.
Well, respectfully, Congressman, I would also would point out that with again staying at the state level, we have a BIT license with New York State, which is indeed a comprehensive consumer protection license that covers crypto activity within the state of New York. On the federal level, I would respectfully say there is regulation of commodity markets, just the way there is regulation of commodity markets everywhere else, and that this new asset, which is not a physical thing that you hold in your hand, still has many of the characteristics of a commodity.
Well, let me respond. My time is getting short. There's so much here. This is an exciting new area, and we're discovering a lot here. But let me switch to the ICO issue. Now, Mr. Rosenbloom, in your testimony, you said you believe it is too early for Congress and the federal regulators to enact a comprehensive legislative or regulatory scheme governing cryptocurrency. Now, I can assure you, I'm the co-chairman of the FinTech Caucus, and I can assure you that none of us on that caucus or on this committee want to be killing good innovation, especially one that is raising, as this is, billions of dollars of capital, because it's very important for everyone to know, and C-SPAN is broadcasting this, but it's important to know that as of February 28th, 2018, individuals and businesses raised $1.66 billion through initial coin offerings or ICOs. So I agree with you, Mr. Rosenthal. However, going back to the SEC and the CFT, they have not proposed rules regarding the regulations of cryptocurrency and other digital assets, and instead have relied on informal rulemaking or enforcement actions. So I want to ask you, particularly Mr. Rosenbloom and others on the panel, what in your minds could the federal regulators be doing better? And do you believe that enforcement actions and other formal guidance are sufficient to regulating and this emerging and exciting digital assets?
Congressman Scott, thank you for the question, and I agree with I think the point that you're moving towards or that you're suggesting here, which regulation by enforcement in an area that is as complicated, as dynamic as this is not the appropriate way to regulate. Enforcement is necessary, of course. However, I do agree with you entirely that we need clearer guidelines, clearer understanding of how the SEC's registration rules, its market trading rules, its exchange rules, its investment company, investment advisor rules should apply and do apply. And that is not something that you can do by regulation through enforcement. And that is, again, one of the reasons I think this subcommittee and this hearing is so important to this process, because we do need more guidance on precisely those areas.
Thank you, Mr. Rosenbloom. I yield back, Mr. Chairman.
The gentleman's time has expired. With that, the Vice Chairman of the committee, Mr. Holmgren, for 5 minutes.
Hi, everybody. Just a quick reminder, Mox News survives solely on your tips and contributions. It's easy to make a contribution or a tip or leave a tip at moxnews.com, or there are clickable links in the text body of this video. It should take the average person, most people, probably less than 2 minutes. Thanks very much for your time and your continued support. Stay cool, Wednesdays. This war is going to end. Till that day.
I yield back, Mr. Chairman.
The gentleman's time has expired. With that, the Vice Chairman of the committee, Mr. Holmgren, for 5 minutes.
Thank you, Chairman Huizenga. Thank you all for being here. Appreciate your work, and this is something that we are all interested in learning as much as we can. I want to address my first question to Mr. Lemp, if I could. Your testimony mentions that you store more than $20 billion worth of digital currency and have traded over $150 billion in assets. In light of the January 2018 hack of the CoinCheck cryptocurrency exchange, wherein $534 million was stolen, I've got a few questions for you related to that cybersecurity side of this. I wonder what cybersecurity standards does Coinbase adhere to?
So, thank you for the question. And the reason I'm hesitating is not my area of expertise, and I apologize when we get into this stuff. But I will say that so our cybersecurity protocols are, I believe, state of the art. That we have an entire team, obviously, does nothing but work with cybersecurity. Approximately 99% of the assets that we hold are held offline in what is known as cold storage, which makes them virtually immune to hack. We do have a hot wallet process for in effect, if you think about it, the cold storage is akin to a vault, the hot wallet is akin to a teller window at a bank. The hot wallet is online, obviously, and we have that amount fully insured to protect consumers and investors as to that.
Are there any, if you know about it, and we can follow up in writing too, or you can let us know who the person is that you recommend with Coinbase that we talked to, but is Coinbase legally required to follow any federal cybersecurity laws or regulations? For example, financial institutions and some service providers are subject to Graham-Leach-Bliley. Securities Exchange and other SROs are subject to SEC's Reg SCI. Is there any other federal cybersecurity laws or regulations that already apply to Coinbase and others like you?
Yeah, first off, I'm more than happy to get you the name with
That'd be great.
The head of our security. And second off, the cybersecurity thing the standard that we are most adhered to is New York State's standard through their BIT license, which is take quite a lot of work. Now we are also working with a few of the big four accounting firms to develop appropriate standards to make sure we're hitting SOC 2 and other standards.
Okay. I think you answered this, but maybe just clarification. In the event of a hack of your platform that results in the loss of assets, is there a guarantee that's provided to the purchasers of the assets through your platform? Do you have any legal responsibility for safekeeping of clients' assets, and what other protections are afforded for your customers in the event that the wallet, the hot wallet is hacked? You kind of mentioned that, but maybe just go in a little bit more detail on that if you have any.
Sure. So again, we're not, we do hold a little bit of fiat currencies, USD, and the United States dollars. Those are held in banks which do have FDIC insurance as to those dollars. Okay. As to our cryptocurrencies, There is no federal insurance program to which we belong. We've attempted to create a degree of comfort amongst our customers by insuring the hot wallet amount. I will note that to date we have not been hacked. We've never had to make a payment out under those programs.
Good. Hope it continues that way. Your testimony also mentions that the exchange only supports 4 assets because each has been determined by regulators to be a virtual currency and therefore not a security. However, you go on to note that regulators are not providing enough clarity for other cryptocurrencies. How do you establish the regulatory and legal certainty for those 4 currencies that you currently support or have? And did the SEC or the CFTC individually provide guidance for those 4 currencies, or did Coinbase make a determination about those 4 currencies based on the SEC, CFTC guidance?
Yeah, we have received some guidance, certainly as to those 4. For example, the CFTC has explicitly found, and in fact published a primer that listed 3 of those assets as cryptocurrencies. The 4th, Bitcoin Cash, is a hard fork, which is in effect a derivative of Bitcoin and be covered by the same reasoning.
Okay.
There are some court cases that refer to them as cryptocurrencies, and the SEC itself has distinguished between cryptocurrencies and securities, and specifically in the Dow report, they referred to Ether as a cryptocurrency in the context of discussing securities.
Okay. You also mentioned in your statement, I'm out of time, so we will, if that's okay if I can follow up, and I've got questions for others. Sorry, 5 minutes goes way too fast. But thank you all for being here. Again, we want to understand this as much as we can, but grateful for your testimony, and we'll follow up with other questions if that's all right. With that, I'll yield back.
Gentleman yields back, and it may behoove the chair at this time to note that we will be having an opportunity to forward questions through the chair to the panel, and depending on our time as well and participation, we may be able to get to a second round of some questioning. So, with your indulgence, so we'll continue to move along. And with that, Mr. Ellison from Minnesota is recognized for 5 minutes.
Thank you. And now let's talk about cryptocurrencies a little bit. In my meetings with constituents over the last several months, I've had many of them say, hey, what's going on with this cryptocurrency? I hear that it started in really low valuation, now it's really high and it's up and down. Should I get into it? I'm like, well, look, I'm no investor. I can't tell you what you should do, but it did occur to me that I should ask you experts, if somebody who's not sophisticated in this area wants to invest, what should they know in advance? Would you all talk about what the hazards might be for an unsophisticated investor in this area?
So that's a great question. It's an important question. And I would certainly say that given the complexity of many of these instruments, it's very dangerous. One of the disclosures that I had suggested would be really critical, particularly as retail investors become more interested in this space, is to understand what the risks are when it comes to investing. It's not only that they can lose a lot of their money, but they can lose all of it. And that it's not just the specific venture itself that creates risks. It's not even the cyber risks or the potential for hacking, but it is a very dynamic ecosystem, that there are certain kinds of changes in the nature of the technology where, say, internet-based principles become embedded in the blockchain and lead some of the blockchain technologies that we're depending on now rather obsolete, where the tokens tied to them then become ultimately worthless. That these are the kinds of risks that retail investors themselves may not necessarily understand, even where they may have some basic, if not only hazy, understanding of the technology itself. And as a result, because just like you, I'll sometimes go to the gym and people will ask me, so tell me about Bitcoin. I think that that is always the sign of trouble, of sometimes either a potential for investors to not be properly informed about where they're putting their hard-earned savings. And as a result, there are certainly, there's a need for much more fulsome communications with those who are seeking or who may be interested in participating in those markets.
So over the course of 2017, we saw, some precipitous increases in value. We saw some drop. We changed a lot. What do you think is driving some of those swings? Is it regulation or the threat or the possibility of it?
I think it's a product of speculation. I think it's a product of
Bubble?
Of a bubble, certainly. It's a product of investors who are of money chasing investments instead of investors chasing money. It's a product of inadequate disclosure. And as a result, I think, just to echo some of the comments here on the panel, that regulation can be very healthy for those markets. It can help to address some of the spikes in volatility and the patterns of fear, the bubbles. But that kind of action is needed now.
So yes, sir.
I would only add that we've had a long history of technology bubbles. I think a lot of what's happening in blockchain technology looks rather like the dot-com bubble of the late 90s, early 2000s. And I think that's important for Main Street investors to understand, and educational programs from the CFTC like Lab CFTC and educational advisories from the SEC are critical, because in the late 90s, it would have been extremely correct to say that pets.com is overvalued, extraordinarily overvalued, and they're going to blow all their money on a Super Bowl ad. And there are some projects in our space that look like that. But it would also be incorrect to say that Amazon.com was overvalued. And I think that's why we see the froth in these markets, because a lot of these projects, say Filecoin or Ethereum or Zcash, are challenging major multinational corporations. And if any of them succeed, they'll be, in the future, as valuable and as critical as the infrastructure that those corporations created. But that's a highly speculative bet.
I only have time for maybe one last question from one last person. So we're talking about regulation here in the United States. The discussion is on. What about other countries, and how does that impact this conversation? Anybody?
So we've been looking, particularly over at Georgetown, some of my colleagues and other people certainly on the panel, at how interoperable are our rules and approaches. The CFTC, I know, has been very interested in terms of information transfers, information exchanges between regulators. I think that one important component to these projects, Lab CFTC was mentioned, I think that's certainly an important and healthy program, but to think through also how do we include more than just a market access component to those agreements, and to push our regulators to also incorporate in the fintech space questions of coordinated regulatory design, information sharing, and enforcement. And I think that that would help to make sure that we can export some of our best values and approaches abroad, and to take best lessons learned overseas and to incorporate them here.
Gentleman's time has expired. With that, the chair recognizes the gentleman from Ohio, Mr. Stivers, for 5 minutes.
Thank you, Mr. Chairman. I really appreciate you holding this very important hearing on a topic that has a lot of people's attention. The first question I have, and I'm going to try to ask 3 questions, we'll see how it goes, is to Dr. Brummer. Can you talk a little bit about the promise of blockchain technology? Let's take a couple steps backward and talk about the promise of blockchain technology to make our financial system more transparent and efficient, and, well, not transparent, efficient, and what blockchain technology can mean both for financial transactions and other things in our economy.
Right. So I think that the value in blockchain technology, and it's very useful for us all to remember that blockchain technology has its applications not only in the financial space, but in other ecosystems, everything from pharmaceuticals and health and real estate and property, that it provides a platform whereby, in a very decentralized format, you can create a system, a ledger, a methodology and mechanism for tracking things and transactions in a way that is extraordinarily difficult to tamper with. And it allows for the disintermediation of certain kinds of folks in the middle that allow for a cheaper transaction experience. I think that precisely because it is embedded in online technologies, the ability to fully lever. Right now I'm going to talk about the upside for just a moment, because I've certainly been emphasizing that there are.
And I'd like you to wrap that up in about 15 seconds.
In 15 seconds.
Keep going, but yes.
The difficulty is that to the extent to which you are operating online, there's more that the regulators can do, federal regulators can do in terms of investor protection, but it also then raises questions. Someone had mentioned money transmitter laws as to how do you coordinate.
That's my third question. We'll get to that in a second. So my second question is for Mr. Van Valkenburg. Can you help us understand the difference between a token that is used as a commodity and the promise of tokens that becomes a security? And if you can do that in about 2 minutes, that'd be great, because we have 5.
It's a great challenge, and happy to try and answer. Thank you for having me. So we have a flexible test in the U.S. for what is a security. It is derived from a case called the Howey case, and that test can be applied for promises of future tokens. What you're really looking for are 2 things: an expectation of profits, I'm simplifying, reliant on the efforts of an issuer or third-party promoter. So that's why this promise of future tokens is critical to thinking about why an ICO is a security, even though other things might not be. Because we have a definable or discernible issuer who's promising to build something of profound economic value, but we're relying on them to actually keep that promise. And that's why it fits the test for an investment contract or a security. Now, a digital commodity might be a digital commodity for a number of reasons. We use commodities for money. We use commodities as investments. We use commodities as inputs for commercial and industrial processes. And the same thing is true of digital commodities like Bitcoin or Ethereum or Filecoin once Filecoin's built. Now, it's important to note that Filecoin is raising money to build itself. But once it's built, it will be, I think, a commodity. Now, I'll just quickly go through those 3 because they're great examples of what I mean by digital commodity. Bitcoin is nothing but something that's scarce and transferable person to person. And that's why I make the metaphor to gold. It's, of course, very different than gold, but like gold, I could hand it to another person, and if that's valuable on markets, that may be valuable and used as a medium of exchange or a store of value. Now,
and I want to do one more question. We got 58 seconds, so if you could do the other 2 quickly.
Ethereum is a computing system on the internet. And in order to get access to that computing system to get useful results, you use Ether as a fuel to power that engine on the internet. It's a commodity like oil.
Yep. And
Filecoin, the last one, is rather like digital real estate. So you use Filecoin to get storage on the internet. So it's a commodity like real estate, if we want to think of real estate as a commodity, measured in gigabytes instead of square feet.
Great, thank you. And one last question for the whole panel, and I know this is slightly off topic, but because it's come up, if folks could comment on whether they feel like FinCEN's 2013 guidance on the appropriate level of anti-money laundering and know your customer safeguards are appropriate, or do you think that they are being abused out in the system? Do you think there's more information needed on those issues? And we could just go down the panel, anybody that's interested in answering that one.
I think it's a very sensible piece of guidance. It was written early on in the space, and it created a lot of clarity, especially for exchanges. And that's why all U.S. exchanges that I'm aware of are collecting information on their customers and filing suspicious activity reports and keeping the financial system transparent, even if it's cryptocurrency.
Thank you. I yield back, Mr. Chairman.
With that, the chair recognizes the ranking member of the committee, Ms. Maloney, for 5 minutes.
Thank you. My apologies. I had to chair for the Democrats another meeting, but this is an incredibly important issue. Thank you, Mr. Chairman, for calling it. Mr. Lemprez, as you know, my good friend and colleague, Mr. Cleaver, sent letters last month to the Bitcoin Foundation and the Digital Chamber of Commerce asking what they are doing to prevent extremist groups like those involved in the white nationalist movement from using cryptocurrencies to fund their campaigns of hate. And I've also seen evidence that cryptocurrencies are used heavily by sex traffickers to sell women. So this is a big problem, and one that Ann Wagner and I have been working on. As Coinbase is one of the largest cryptocurrency exchanges in the world, what are you doing to prevent these extremists from using your exchange to fund their activities? Do you have a set of standards, or? Thank you.
Yeah, thank you for the question. Let me first off by say that we take that very seriously. Specifically with regard to hate groups, for example, we have a specific section of our terms of use that we rely on, and we kick people off the platform anytime we see anything that that constitutes either encouraging or facilitating hate on that through our network. The speaking more broadly on sort of bad actors and the things we do to track them down, is one of the nice things about this technology. It actually gives you insights that you can't get in any other financial instrument currently, because of the nature of the blockchain, which is an immutable permanent record that's publicly available. We use both internally developed and commercially available blockchain analytic tools, which actually give us quite a bit of insight into connections between individuals. If, for example, we were to identify some kind of bad node or some bad activity, we can track to see who's touched that and what relationship they'd have with anybody else who might have touched that. I should mention that we are members of the Bank Secrecy Act Advisory Group. We work very closely with FinCEN. We file an awful lot of SARs. We have, just to show how important we view this space, we have nearly 20% of our total employees are dedicated towards compliance.
Thank you. Thank you. And as I've said before, I'm extremely concerned about virtual currencies because a lot of average people are using it and believing that it's an investment tool. They're pouring their life savings into virtual currencies, and they stand to lose a lot of money when this bubble eventually bursts. Some people are treating these things as investments, not as currencies. And that's a huge problem because there's no investor protections like we have for stocks and bonds. So I'm working on a bill that would regulate virtual currencies, but not the technology, that have the characteristics of an investment, like we've always regulated investments, with robust investor protections, including disclosures, which will be regulated by the SEC. So, Professor Brummer, let me start by asking you a question. Do you believe that the definition of a security in current law encompasses all virtual currencies?
No, I don't believe so. The Howey test, which is long the standard for evaluating non-traditional financial products and determining whether or not they fall within the SEC's regulatory perimeter, establishes several key characteristics and benchmarks that have to be satisfied. And I think that when you apply them to some of these virtual currencies like Bitcoin, you get less than fulsome results according to those benchmarks.
So if we wanted to regulate virtual currencies that are being treated as investments and to require adequate disclosures to investors, would Congress need to expand the SEC's authority, in your opinion?
They would need to expand the SEC's authority, yes.
And I liked the part of your testimony where you described what kinds of disclosures should be made to people who invest in initial coin offerings. And I agree that the SEC can tailor the required disclosures so that they're appropriate for digital tokens and virtual currencies, which are different from traditional securities. Do you think that requiring these kinds of basic disclosures would stifle innovation in this space or harm the development of the blockchain technology?
I really don't think so. I mean, the kinds of things I've outlined, adding mailing addresses.
And I have 15 seconds left. Professor Brummer.
I'm being generous with the time.
I know my colleagues need time too. What do you think of the idea of subjecting virtual currency exchanges to minimum cybersecurity standards? Do you think this is necessary in light of the huge cybersecurity risks that virtual currency exchanges face?
I think that would be extremely helpful. Cybersecurity is perhaps the #1 challenge facing our financial markets infrastructure providers, and to the extent to which you want to provide those financial services, you should be subject to certain kinds of high expectations about the cybersecurity of your operations.
My time is more than expired. Thank you so very much. Thank you, all of you. Thank you.
With that, the chair recognizes the gentleman from Minnesota, Mr. Emmer, for 5 minutes.
Thank you, Mr. Chair. Appreciate it. Appreciate all of you being here. This is a huge topic that cannot possibly be even scratched in my mind in 5 minutes with each of the people that's up here. I have a whole litany of questions, which I know my office will follow up through the chair with each of you. I think where I want to go this morning after listening to you because I find myself maybe not with my colleagues on some of this. I have a problem with government is here to help us, and we need more government. We're going to have to go into this new frontier, and we've got to have more regulation. I mean, I heard at the beginning we have a regulatory vacuum. That scares me to death. I tend to trust people before I distrust them. I tend to believe that people are in these things for good, that they're trying to improve their own lives and hopefully the lives of people around them, that old adage of a rising tide lifts all boats. And yet I hear elected officials who don't have any concept of what we're dealing with here and how exciting it is, talking about, oh my gosh, we got to run in, we got to regulate, we got to create more government infrastructure. And by the way, I respectfully disagree with the idea that that won't act as a wet blanket on this amazing new technology. What we're talking about here is blockchain. Blockchain technology applies all over the place. I mean, it can solve some of our cybersecurity issues. These are open transactions where Milton Friedman, of all people, predicted this back in 1999 when he said there will come a day in the financial services space where you will be able to do this over the internet, where A will have a transaction with B, and it'll be entirely open for people to see, but A won't know B and B won't know A. You can know that, and you can see things. I think Mr. Lemp was talking about how you can see things through the blockchain that are going on. I love the fact that Mr. Rosenbloom talked about examples of blockchain technology outside of this space. And I will tell you, in Minnesota, we have a company called BankU that's using blockchain to provide digital identities to unbanked and underbanked individuals in order to build a credit history and access capital. I mean, that's something that Democrats and Republicans should be celebrating here in Congress, not going, oh my gosh, this is terrible, we don't understand it. We need a new policeman, or we got to take the policeman we already have and give them even more powers to start to invade this space and perhaps frustrate the development. I have concerns. I realize there has to be some regulation, but it's the balance. And I've heard from the panel that we have regulation already in place. We just need clarity. Mr. Lemp, why don't I start with you? You talked about we have to be able to say what is a security in this space? What is a commodity? I would add, what is currency? Because these are all important definitions to whether or not certain agencies are within their jurisdiction. And to have you say two things really scared me. One, that you haven't made any offerings because you don't have the certainty you need to know whether or not you can start to work in this space. And second, to say that 20% of your workforce is working on compliance, that's nothing to be celebrating from this side of the table in my mind. So I just ask you, what about clarity in this issue, in this area, and what about the balance that I'm concerned with?
Yeah, thank you for raising it. It's obviously a very, very important issue. We, going to certainty, I can tell you that from our standpoint, what we really need more than any particular approach is to know what that approach is going to be from the government so we can plan and we can move. This system innovates very quickly, and just knowing where the lanes are is extremely helpful for us.
If I can interrupt real quick, I'm sorry, because I'm thinking at a conference that I was at last week, one of our very important and respected secretaries made a statement about everybody needs to register. Well, there's no clarity around the law, so all of a sudden people who are looking at being in this space or getting into this space, I heard from more people there after that comment that we can't start our business in the United States. We're going to have to go somewhere else to start it. I mean, does that concern you?
It does, although I will say the entire world is struggling with these same issues. And with regard to the percentage of our team that's focused on compliance, the biggest piece of that is focused on Bank Secrecy Act, know your customer obligations, people that are concerned about money laundering and counterterrorism, things like that. And that's an important element no matter which country we're operating in. And certainly any developed country, we will have those expectations.
And we should work with all of you to understand better those things that would work. I would just leave you with this. Right now, this system gives advantage to the individual and not to the government. And I'm worried about giving advantage to the government and taking away liberty from the individual. So hopefully we'll be able to meet that balance as we go forward. Thank you, Mr. Chair.
The gentleman's time has expired. With that, the chair recognizes the gentleman from Illinois, Mr. Foster, for 5 minutes.
Thank you, Mr. Chairman. And before I begin my testimony, I'd like to ask unanimous consent to enter into the record a letter on behalf of Congresswoman Sinema from an Arizona-based blockchain company in support of this committee's investigation into this area.
Without objection.
Thank you. Distributed ledger technology has tremendous promise. The value of a non-falsifiable ledger will have broad applicability to financial and non-financial transactions. It could reduce transaction costs, increase transparency, and provide for instant and final settlement in areas ranging from cash transactions to real property records to securities. It also provides a platform for more speculative transactions such as Bitcoin that are backed by nothing. More than perhaps their scarcity and the belief that there will at some point be a greater fool to take them off their hands at some unknown price in the future. But nonetheless, much of our daily lives will soon involve something like blockchain. So I think it's past time that governments around the world have a look at these digital tokens and figure out where and how they should be used. And it strikes me there are three fundamental questions that I'd like your reaction to that we have to face. The first is, will there be a mechanism to bust trades or not? In the case of the flash crash, for example, the CFTC had very clear rules in place under which case market gyrations would result in trades being broken. There's no such mechanism, for example, in Bitcoin, where if someone steals your Bitcoin codes, they have it and you cannot get it back. Similar questions arise if a hacker absconds with the contents of your vault. You know, is there a higher authority that you can go to break that trade? So that's the fundamental design question that I think you face and that we face as regulators. Secondly, is there a need for something equivalent to a consolidated audit trail? In the securities space, we have learned by bitter experience of the need, if we're going to detect and prevent market manipulation, we need to have an electronic record of the timing and the beneficial owner behind every transaction. You know, that could be designed into digital entities like this, or it could not be. And thirdly, related is the authentication of participants. You know, will there be a mechanism, if necessary, with a court order or with an order of the regulator to unveil the identity of counterparties and issuers? That's something that could be present or could not be in any of these. And so I was wondering if you have, a reaction to how you think we should address those three issues: busting trade, a consolidated audit trail, and authentication of participants. I'm just happy to go down the line here.
Sure, I'm happy to start with it. With busting a trade, there's technological challenges to that, right? These trades, once they occur, or a transaction, once it occurs, has occurred. There's no opportunity for a settlement 24 hours later or something else where you can look at it and pull it back. So that is a challenge.
Yeah, but there are technological means of doing that where every transaction would be conditional on the fact that some trusted set of entities haven't publicized a code that invalidates the trade.
Yeah, it's good.
There are technological ways of doing that, but everyone has to understand that it's not like cash. You know, if you steal cash, it's yours. All right, and with the exception of serial numbers and so on, you pretty much own that cash. But it can be designed differently. And all right, anyway,
no, it absolutely could be. It absolutely could be.
So the consolidated audit trail.
Yeah, unless those two items I put together, the authentication of participants and the consolidated audit trail, I'll let you know that certainly if you're trading on our platform, we have information on you. We have your bank account, typically. We have a lot of know your customer information. So we know the individuals, we know where they are, we verified their identity, we know the source of funds. We know quite a lot about them. And there is an immutable record that once it's created. So in many ways we have, while it's not a consolidated audit trail in exactly the terms you're looking at, we have much of that information gathered on our platform in a form that we are able to reconstitute it if it becomes necessary.
Okay. All right. Dr. Brummer, do you want to take a swing at those?
Get your microphone, please.
Other than saying that I'm sympathetic with your objectives, I'd have to defer to Mr. Lemp as to how the internal operations will
Okay. Mr. Rosenbloom?
Sir, I think to to take all of your questions, we have to step back and look at a couple things. There are a number of different currencies, and there are a number of different items being traded here, and there are a number of different places in which they get traded. So if you're talking about Bitcoin or other things that we'll view as pure currencies, right, which is probably where this question starts from, I think there are one set of answers to those questions. I promise to get to those. The second thing, though, is when we're talking about the new tokens and things that are being developed for particular platforms, those are very different, right? And there's at least two places that those can be traded. One is on the platform itself. Second is on exchanges, most likely exchanges registered with the SEC. When we talk about exchanges registered with the SEC, I think your notion of having all three of those things exist will absolutely happen, right? I think the question of if we move, and I think with well-regulated, well-thought-out platforms, right, that type of, at least to a large extent, all three things that you're talking about, identifying customers, having a consolidated audit trail or some kind of trail, and being able to bust trades can happen on those platforms. I think when we move to something like Bitcoin, right there, I think you have a much more difficult problem with this because that genie is already way out of the bottle, right? And that trading, the ability to trade Bitcoin throughout the world, it's very difficult to put in at least a know your customer rule or an identification rule. For example, you have a wonderful consolidated audit trail. You can follow Bitcoin throughout the trail, right? You just don't know who it was who held it, right? So that one, I think, is the one that that's going to be much more challenging for this subcommittee.
Gentleman's time has expired. With that, gentleman from Ohio, Mr. Davidson is recognized for 5 minutes.
Thank you, Chairman, and I thank you all for your expertise on the topic. In the rapid expiration of 5 minutes has been duly noted, so I'll try to crank through this. I really appreciate the dialogue that's been had about the differentiation between commodities and securities, and Mr. Vandenberg, sorry about that, Valkenburg. My apologies. Wanted to spend a little bit of energy on that because as these securities are offered, in a way, I think you did a good job of highlighting what might look like a commodity with a test. But a lot of times when people go to market, these aren't like shares in a company. They're, if you think of them as a sort of an equity, they're non-voting shares, and some of them aren't even committed to a dividend, and those that are committed to have some sort of return in their structure, how is it that I make money for it? In some ways, it looks almost like a bond. So could you say, look, if we were filing for securities, which people haven't done yet, Part A plus, Part D, Part S, what does that look like to treat it as a security in common frame of reference for folks?
Thank you, Congressman. I'd first start out by saying that there are several developers who have sold their tokens through Reg D filings, and they're not selling the tokens in that case. They're selling a promise, an investment contract in the true meaning and spirit of the Howey test, wherein they're going to make efforts, people will rely on those efforts, and the outcome will be something profitable. But the outcome in many of these cases is a brand new decentralized computing system that has baked into it tokens which can achieve some sort of functionality. Once that system is built and the investors who bought in, say, a Reg D offering are given the tokens, those tokens, to me, assuming the network's functioning, that people are now relying on the blockchain instead of the issuer, they're relying on the blockchain the issuer created for proof of ownership, for the functionality that that blockchain creates. At that point, it looks more like a commodity. At that point, maybe you can do something useful with the token, like use it in an engine for cloud storage, or use it in an engine for computation, or hold it as a valuable and scarce commodity, like gold or salt or things like that.
Well, thank you. And in that sense, shares have many of the same features, and of course, they're treated as securities. Mr. Rosenbloom, I want to spend a little bit of time talking about a lot of the companies that raise this capital are early stage companies. And historically, one of the paths to capital for early stage companies, venture. Venture is often considered smart money. You get the benefit of lots of experience helping small early stage companies navigate to scale up. ICOs don't always have those features. Last year, it's estimated that startups raised about $4 billion in ICOs. Can you talk a little bit about the concerns with respect to venture versus ICOs?
Thank you, Congressman. Actually, let me say one quick thing. I'm the only one on the panel who has not been asked about security versus commodity. So if somebody at some point wants to ask me, you're going to get a very different answer from me on that question than the other panelists. To answer your question, sir, one of the things we have seen in the ICO market to date has been a large number of people, large number of companies raising money in ways that any securities lawyer would have told you and truthfully did tell you that you shouldn't do. So, for example, Dr. Brummer's suggestions about how to improve a white paper, to me I understand the notion, but no rational securities lawyer will ever sell or advise their client to sell off a white paper. We always sell off of a private placement memo or a disclosure document. We always have risk factors. We always take all the steps you need to for an ICO in exactly the same way that we do in a private placement for any other security. Right? And so one of the things we've seen, and then I know time is short, sir, but one of the things we've seen are market practices that have been detrimental, I think, to the long-term development of the ICO market.
Yeah, thank you for that. And I think a very good distinction, and I like that you hooked back in this notion of a white paper and how soft that is versus a private placement memorandum. And I guess, to your point, if I could hear your perspective on commodities versus securities, I'd appreciate that as we close.
Thank you so much for the invitation. So I think that the notion of trying to decide what is a security and what isn't a security is something that would lead the market to distraction. To take the notion that once something becomes functional, once a platform becomes functional, you no longer have a security, it's got to be wrong. You can be still relying very extensively on the efforts of the promoters. Trying to draw a line on when it is that you're no longer significantly relying on the efforts of promoters is so very difficult and so convoluted and so open to second guessing. My suggestion is don't even bother. Come up with a simple, easy system to use eventually that's going to apply to all of these things, regardless of whether they're secure.
Thank you, and thank you, Chairman, for the additional seconds. I yield.
Gentleman's time has expired. With that, the gentlelady from Missouri is recognized, Ms. Wagner, for 5 minutes.
I thank the chairman very much. Mr. Lemp, in your testimony, you stated, and I quote, "We need to be sure that we are not killing good innovation brought about by new technology and good actors." For example, the state of New York requires a bit license, which has been unpopular, causing companies to end their business relationships in the state. Mr. Lemp, let me start off by asking you two questions. Since Coinbase is one of 4 companies who have received a bit license, do you believe New York's model was appropriate for all industry participants? And secondly, what lessons can we learn from New York's attempt to regulate the virtual currency market?
Yeah. Thank you for asking. And we are one of 4 companies that's received it. I think an obvious lesson is the state of New York made it was a very ambitious effort by the state to regulate in this space. The fact that they've only issued 4 licenses, I think, answers the question to a certain extent. They have chilled activity in the state of New York. Mm-hmm. Having said that, when you're at the scale that we're at now and the number of individuals and institutions that we're dealing with now, we do benefit from the comprehensive regulatory scheme that the state of New York has put in that people do trust more that we're doing the kinds of things they want to see when we have people who are used to dealing with financial institutions, and the state of New York is in effect treating, through its BIT license, us and other companies the way they treat financial institutions. I think that sends a message to the market. So for a company of our size, and again, there are 4 that have this license, mm-hmm. we have found benefits in dealing with the state of New York on this. I would note that there are hundreds or thousands of companies in our space, and obviously only 4 of them are operating in New York under that authority.
What are other state laws that regulate cryptocurrencies?
So we have 40 licenses in 38 states. So they're primarily money transmission licenses that we deal with, but they lead to full exams. We've, I believe, had 28 exams to current various states coming into our offices.
Okay, switching topics somewhat, I wanted to talk about compliance a little bit. As a registered MSB, Coinbase is required to submit suspicious activity reports, or SARs, to FinCEN. Mr. Lempres, I understand that Coinbase includes blockchain analytics when filing their SARs. Can you explain to the committee how including this information allows FinCEN to get a more complete picture of what is going on?
Yes. Yes, and thank you. So you're correct in all of your parts there, that yes, we do file SARs with FinCEN, and that we do include blockchain analytic information where it's helpful in that SAR. And the reason we do that is simply to do everything we can to put into context the information we have. We have access to information that many federal agencies don't see on a day-to-day basis. We see it all the time. We try to tie it together to present as accurate and complete a picture we can, so that if further investigation is warranted, they at least have the broader context in which it's operating.
As a follow-up, can you talk about how Coinbase coordinates with law enforcement and how your Know Your Customer program was developed?
Sure. So we're quite proud of our involvement with law enforcement. We have a group, our Global Intelligence Unit, that focuses exclusively on law enforcement coordination and education. We train, I believe, more law enforcement agencies globally than anyone. We've trained hundreds of state and local agencies. And when I talk about training, it's essentially how the blockchain works, how cryptocurrencies work, what information is there, and how a case can be put together if they need to put a case together.
Mr. Van Valkenburg, in your testimony, you mentioned that there is friction and mismatch between new technology and old regulatory structures when it comes to state-by-state money transmission regulation. Can you explain, sir, how the current state regulatory approach poses issues with regard to cryptocurrency exchanges?
Yes, thank you. The first thing I'd say is these are naturally global technologies. They work on the internet, so when people use them, they necessarily cross borders. And a company like, say, Coinbase will have customers not only in every state, but probably across the world. And that means that compliance, when it's done at a more local level, is very burdensome and often redundant. The 40th background check that your company gets will probably not make you less likely to, or more likely to be secure, or to have you know, a good reputation. It's just it's extra. Now, the other friction or mismatch between state money transmission licensing and these technologies, especially at the exchange level, is that money transmission licensing relatively exclusively focuses on this idea of transmission, A to B, not on the idea of custody as clearly defined, but on the idea of transmission. And there are all sorts of people in the world who are developing these technologies who facilitate transmission because they write highly innovative software that help power these new blockchain technologies. They're critical to this innovation. And they don't take custody of consumer funds. So they don't actually put customers in risk, but depending on how a various state money transmission licensing statute is drafted, you could interpret it to say that that software writing activity is included as money transmission. And the penalties for being an unlicensed money transmitter are very grave. So if we could clean up that statutory language state by state to make it clear, folks that hold people's Bitcoin, like my colleague's company, Coinbase, are licensed, but people who don't actually hold it are not subject to a licensing requirement. That'd be a very positive signal from the U.S. that we're willing to protect innovation where it doesn't endanger consumers.
I thank you all for your testimony. My time is way expired. Yeah. Thank you for your indulgence.
We've been somewhat generous today on that. Knowing how this is, how do you unravel this in 5 minutes is very difficult. And still, while we are in this first round, welcome back to Mr. Sherman, who is recognized for 5 minutes.
Thank you. A currency is both a store of value, one you hope appreciates, and a medium of exchange. So let's focus on the medium of exchange. Is there any reason why I would need a cryptocurrency to pay for my groceries or anything else? Why would I, that wouldn't be adequately served by using dollars. Yes, Mr. Van, yes.
Thank you, Congressman. No, not yourself, I believe, sir, because you and I are...
You're assuming I'm not a terrorist or a criminal, and I thank you for that.
No, I'm assuming you're an American citizen, which I think is a pretty safe assumption.
That one's safe. The other two are questionable. Go ahead.
You and I have the benefit of a well-functioning and extremely important financial infrastructure that's around us every day, of credit cards, of bank accounts, and most Americans do find it not too difficult to become banked. We have an unbanked problem in this country, but it's not nearly as profound as other parts of the world. In other parts of the world...
Is there any part of the world where the unbanked couldn't just as easily have access to transactions in real currencies rather than cryptocurrencies?
So there are parts of the world where real currencies in those countries are being basically debased by their governments or hyperinflated, or they just don't have actual purchasing power because
right. So you could use dollars, euros, Swiss francs. Why are those not the adequate substitutes?
If you can find access to cash in your region of the world, US dollars, that might be a very good means of exchange, but those will trade at extreme premiums. My only point is that cryptocurrencies are accessible. They're accessible financial tools only on the basic precondition that someone has a smartphone and an internet connection. And I think there are regions of the world where people will sooner have smartphones and internet connections than they'll have access to valuable and secure financial services from companies.
I wonder if someone else can comment on that. I don't think in the tallest mountain of Tibet, there's somebody with a $100 bill that they're holding on to. And on every cell phone, there's a way to use dollars or euros. Does someone else have a comment?
Mr. Sherman, thank you for the questions. I want to divide your question into two different parts. One part relates to things like Bitcoin and other currencies, which is really what you're discussing. Second part is going to relate to tokens and similar types of things that have instruments that have specific purposes on specific platforms that people can earn and generate in ways that you could not do with cash.
What? I have limited time. Focus on what can't you do with cash?
Well, in a platform, for example, where we have a buyer of property, sellers, and then we have third parties who are performing important services to the platform to help the platform run, to help validate services, to help do other functions that are
important. And why can't these platforms use dollars?
Because there's nobody who's going to pay them. What happens on these platforms is that the platform itself...
Wait a minute, I have a bank, I pay them one way or another?
No. You have to find a source. You have to find somebody who would be in the business of paying them, and that costs money. So what you see in these platforms, what you see in...
Sir, I've lived my whole life. I'm as old as almost anybody in the room.
Oh, sir, that's very kind of you to say. But
various intermediaries have handled my financial transactions my entire life, and none of them have gone hungry.
We're talking about a very different business model, right? Then that's one of the things that's so important about this, so important about this.
We know that this is a good method for terrorists, criminals, and tax evaders. So the question is there some great social purpose that cannot be met in any other way? I want to hear from a different witness, and I don't see one volunteering.
Honestly, I think it's an important question because you're getting ultimately to this question as to whether or not many of these cryptocurrencies, and I think the vast majority of the cryptocurrencies tied to ICOs are really just means by which you're raising capital as opposed to currency. I will say...
Well, raising capital, but unregulated, doing an IPO, but calling it an ICO.
Well, one of the key responses I was trying to make for Mr. Rosenbloom when discussing the adequate disclosures or the kinds of disclosures that one would like to see in a white paper is precisely in order to beef up those white papers so that they become more compliant with the expectations of our securities law, which I think is an expectation that all securities lawyers would enjoy. But I am very sympathetic to that.
But if I go buy an ICO and the company sells great pizza and eventually makes billions, I don't get any of that, right? I'm not a stockholder.
But sir, the important thing on those tokens is the company that creates the platform may not have any financial success on the platform. And the fact that the platform becomes very successful may not redound to the benefit of the entity that created the platform.
Okay. Well, perhaps we'll have another hearing after some major terrorist event financed by cryptocurrencies, and I yield back.
The gentleman yields back. With that, gentleman from Connecticut, Mr. Himes, is recognized for 5 minutes. Currently passed. Okay. Well, we have some people potentially in transit, but if it is okay with my colleagues, we'd like to go on to a second round, which basically means I get to ask another question finally, after having a number of them. And Mr. Rosenbloom, you asked for it. So differences between a commodity and a security.
So in this case, as I said before, it's very difficult to know where one begins and one ends. Right? The notion of saying, well, something has usage. Right? If we go back to the citrus groves that were at issue in the Howey test, there's no doubt that the citrus groves had usage. They really produced some kind of citrus fruit that people really sold. Didn't mean that the participation interests in those were anything other than securities. Right? The problem that we face is that I can draw a line for you that says when the promoters' efforts of on the platform become less important than the commercial usage of the platform in driving the token value, probably it's no longer security under Howey. What I cannot tell you is a good test or a good set of factors to look at that tell you with any great certainty when you get to that point. So the thing that I keep suggesting to people on this is I think that in the long run, we shouldn't worry about that issue. We shouldn't worry about the distinction between this is a commodity, this is a security, and how they travel back and forth between each other, but instead have a simple system, move to an environment where we have a simple system that works for both, and we don't have to have lawyers like me argue with other lawyers and argue with courts and argue with the SEC over which side of the line it is.
So can I just jump in for one quick observation and it responds to something that you said, which I think is really quite useful. When you think about the citrus groves, right, in the Howey case, this famous Howey case, you had oranges. The oranges themselves were commodities. It was the combination of the oranges of a service contract, right, basically with an opportunity to invest in them. It's the combination of it all where the whole is greater than the sum of its parts, right, and then you end up in the world of a security. However, I would say that there is a difference in terms of how commodities are regulated under the CEA, right? And how securities are regulated. And securities regulators, for example, tend to put a little bit more of an emphasis on disclosure. The relationship that the SEC has with infrastructure providers and other market participants there's a different level of reliance in the commodities world versus the securities world. And these are things that I think that you as a committee really ought to take into consideration when you're drafting any potential legislative response. And I'd like to also emphasize that when we think about a commodity, one of the commonalities between commodities world and securities world is an awareness that digital things tend to be more abstract, and therefore they tend to be a little bit harder to understand. And as a result, there is a bit more of a tension that is focused and placed on those products. So gold is the quintessential commodity because it's finite. People tend to like shiny objects, and it is universally identified as something that has value. Here we're debating a lot of that, and as a result, our regulatory authorities and you
and so based on those regulatory authorities, and we saw my colleague, Mr. Emmer, talk a little bit about this, and I see the natural tension. You've got people saying, there is no way I want any governmental regulation on this. In fact, we came up with it, get out of it. This is a free fire zone, and we like it that way. Government bureaucracies and agencies tend not to view the world through those lenses. And I think there is a certain governmental responsibility to protect those investors versus a known investor or a unique investor that is sophisticated in that. And I've got a minute left here, and I'm going to be tight on this 5 minutes here, but I am curious, and anybody can answer this, will a governmental central bank in any system recognize and utilize a cryptocurrency? Because I think until that point, this is going to be a bit of an outlier, and whether it would be some small country or some others, I mean, it seems to me the only way that there is going to be an ultimate legitimization of a cryptocurrency is whether a central bank somehow recognizes it. Anybody?
Mr. Chairman, I think several countries in Europe, for example, and in Latin America have already thought about and already considering digitizing their currency. So I think that that is something that may very well happen. I wonder, though, whether to at least
but that's a little different. That's a governmental created currency versus a non-governmental currency at this point, right?
Well, that's right, but I'm not. I wonder what the difference is, right? Once we've moved away from the Bretton Woods Treaty, right, and once we have currencies floating freely around with each other, I think in one sense what we're worried about is that Bitcoin isn't backed by a state actor, and that's about it.
Okay. With that, the gentleman from Georgia is recognized for 5 minutes.
Thank you very much, Mr. Chairman. And you know, again, I'm so excited about this new cutting edge, what I call the new frontier of our financial service industry, and it's an exciting time for us. But here, let me give you all this scenario. We got millions of new investors who are literally pouring their savings into virtual currencies here. And it is a wonderful thing. As I said before, it's burgeoning up. It's billions of dollars in capital being raised. But then these facilities in this virtual currency are facilities that store and they transfer these digital assets for investors, which are known as digital wallets. But here's the problem. These digital wallets have become targets for hackers. And hackers are using social media, phone calls, and ads on search engines to fool investors into providing them with sensitive personal information that they can use to gain access to accounts at digital wallet providers and steal literally thousands of dollars worth of virtual currencies. Hackers have also targeted the digital wallets themselves, exploiting the vulnerabilities in their cybersecurity systems. This was brought to my attention by the SEC Chairman Clayton. He's pointed out that digital wallets storing or transacting digital assets that are securities can trigger other registration requirements under the federal security laws, including broker-dealer, transfer agents, or clearing agency registration. So, panel, what I want to ask you, what are the benefits to investors of digital wallets registering with the SEC? Would that help to defer? These are the kinds of technical and complex questions that present us as members of Congress because it all falls on our shoulders. And most certainly we want to be responsive. And as I said before, as chairman of the co-chairman of the FinTech caucus, I am very proud of this industry. But I also know, for example, the OCC may come, they're flirting from one position to the other of doing a special order charter for fintechs. And then you have all these regulators boxing around of how to identify them. But all this comes to our lap. So, and if they are registered with the SEC, should these digital wallets be subject to enhanced cybersecurity protocols, such as Chairman Clayton said, as the SEC's regulatory systems compliance and integrity of regs, SCI. I mean, we're dealing here with an opportunity to get it right before we get it wrong. So tell me, Mr. Van Hollen.
Thank you, Congressman. I think the testimony of both Chairman Clayton and Chairman Giancarlo before the Senate Banking Committee is extremely important to take a look at, to think about how those two regulators are construing the space. Chairman Clayton, as you rightly said, talked about tokens that are securities, either because the token does represent a legal agreement, it's a company saying these are shares of our stock, or because the token is a speculative promise of future efforts, fits the Howey test. But Chairman Clayton also talked about what he called pure cryptocurrencies. He used the term in several different occasions. And the chairman suggested that those are outside of SEC jurisdiction. And if you look at one of his responses to the questions, he said, do not misconstrue me saying that's outside of our jurisdiction as asking for more jurisdiction. And I think that's probably because the colleague sitting to his left was Chairman Giancarlo of the CFTC, an organization that has expertise in policing markets for scarce commodities, which pure cryptocurrencies, I would argue, very much are. So I think we want to look to the institutional competencies of these two different agencies to protect investors. And that means the CFTC will continue to use its existing authority to police spot markets for fraud and manipulation if the spot market is trading commodities. And the SEC will ensure that only tokens that are securities are traded only on ATSs or national securities exchanges, which will have to go through all of those cybersecurity requirements. Now, where there might be a gap, if there's any gap, is the fact that the spot markets for cryptocurrencies are policed by the CFTC ex post, not supervised by the CFTC ex ante for things like transparency, cybersecurity standards, and the like. Instead, they're supervised by the states in a patchwork approach that includes the BIT license and others. It might be time to rationalize and federalize that supervision of cryptocurrency markets.
And so if you saw those two
Sorry, the gentleman's time has expired.
All right, thank you, sir.
With that, gentleman from North Carolina, Mr. Budd, is recognized for 5 minutes.
Thank you, Mr. Chairman. And again, thanks to each of you all for being here today. Peter, I want to publicly thank you for the private briefing that you and Jerry gave several weeks back, and just say how helpful that was, and just to encourage any other members, staff on either side of the aisle just to reach out. You guys have been very helpful in bringing us up to speed on this, so thank you again. So I want to make a statement and then ask a few questions. One, regulation in this space is something that the U.S., we have to get right. Because poor or rushed policy with respect to cryptocurrency and tokens, in my opinion, it really threatens America's leadership in finance and in technology. So we have to be careful to avoid missteps. This technology has potential to become something great. So I just think that we should move with caution here. And on that note, so I'm curious about an idea that I've heard and being floated around as a potential regulation scheme for cryptocurrencies. So this idea would divide cryptocurrencies into securities and non-securities, with security coins being regulated as securities and non-security coins being regulated as commodities. So the obvious difference between the two being the security coins would offer dividends or equity or anything that did not, would again be on the other side, would be on the commodity side. So I'm curious, Peter, to get your thoughts on this idea first, and then Dr. Brummer, if you have any thoughts, if you could answer that as well.
Thank you, Congressman. The first thing I'd point out is that this is a global technology, as you rightly said, and if U.S. laws are not a good fit for both the innovators and the investors, as far as protecting them but also enabling markets, these technologies will move to other jurisdictions. The Congressman is, I think, correct that a sensible way of dividing these markets is between things that are more commodity-like and more security-like. And in the US, the flexible test for security, the Howey test, is the tool for doing that. But it is not the tool globally. In Europe, for example, there's more of a black letter law approach than a flexible test. Certain things have been identified in various European jurisdictions as securities, and they're more of what you suggested, things that clearly offer a dividend or some sort of capital return on investment. Finding a more bright line test may be useful, although the SEC's flexibility with the Howey test can be very helpful in going after schemes that pretend to not be securities by not offering those formal things. So finding a way forward is not easy, but probably worth considering, because at the moment you see many more of these, I think, truly innovative capital formation opportunities moving over to Europe. You see a lot in Switzerland, you see a lot in Germany, and these are not countries with lax securities regulations. These are just countries with a more certain legal test. So I think guidance from the SEC as to how they'll interpret the Howey test with respect to token sales, they've already had a lot of very deliberate statements that have been very helpful, but further guidance might be helpful, especially with respect to exactly how you draw the line. And it might look more like what Europe is doing these days.
So I guess my first response is that Europe's approach on this is very much uncertain, number one. Number two, they don't have a definition in place firmly for virtual currencies under MiFID and other European Union regulations and rules, and they're grappling with these same issues just as we are today, and there's an enormous amount of uncertainty as to how that's going to just play out. I think when it comes to the commodity securities question, I agree with Peter. Maybe there's a little bit more of a difference of tone. Institutional competence is extremely important when thinking about who should be regulating different financial products. My testimony today emphasized the question of disclosure. And I think that even when I think that Bitcoin is not the same as gold, and I think that people intuitively understand it a lot less. And so this creates very important questions as to what kinds of disclosures should be related to even sort of pure cryptocurrencies that may legally, under current law, resemble a commodity or be classified as a commodity as opposed to a security, because the disclosure process available under the CEA is more or less of a kind of, just buyer beware approach versus a much more fulsome approach adopted under the SEC. And so a decision has to be made as to not just the competence, but even under existing rules, no matter which, excuse the pun, side of the coin you may fall, there will be some kind of subsequent rulemaking required in order to adopt and to adapt your existing regulatory processes to a virtual currency. And I think that it's important that people recognize this, that there's going to be work that will have to be done, both on the SECs and as well as under the CFTCs, and in order to get it right.
Thank you both. I yield back.
Gentleman's time has expired. Gentleman from Connecticut is recognized for 5 minutes.
Thank you, Mr. Chairman. I'll yield my time to Mr. Scott.
Thank you very much, Mr. Hines. I appreciate that. Mr. Valkenburg, you hit it on the head as to what I think we have an obligation both to this burgeoning industry here as well as to the safety of the American people. All this technology that we have being applied in very sensitive areas makes us become almost the servants of the machine technology that was created to serve us. And we got to get this right in terms of what I think is a delicate balance of the right kind of regulation that really helps to solve the problem. We got hackers out there that are at work and damaging great careers and jobs and just the lives of the American people, and they look to us here in Congress to try to solve that. And so when I brought that issue, you brought up how the CFTC and the SEC would work together in working with this, which presents another problem that we have. And let me ask you, in that situation, the great need for harmonization, because that's a problem we have. When we have these regulators involved, and you have several regulatory agencies, it puts your industry in a somewhat an awkward position trying to figure out and try to make sure that they're both coming at it the same way. So would you recommend that whatever we do, knowing these different agencies, that Congress put in, whatever we do, a rule for harmonization?
Yes, I do think harmonization is critical. Chairman Giancarlo, when he talks about policing authority over these spot markets for commodities, emphasizes that they don't have any ex-ante authority. They don't have the ability to supervise beforehand. They're not the regulator on point. And as I was briefly saying earlier, the regulator on point is largely the states, whether it's through the BIT license or through money transmission licensing. And so it's not just anarchic as between federal agencies, potentially. It's anarchic as between federal agencies and various state regulators. I think state-by-state money transmission licensing is both the biggest impediment to the technology because of the profound and redundant and non-productive costs that it imposes on the industry and on the ecosystem. And it also is not an adequate way to protect consumers or investors. I think we need to start a conversation in Congress about federal preemption of state money transmission licensing law that would also include sensible investor protections for those who become licensed by a federal authority. And Chairman Giancarlo, in his testimony before the, I believe it was before the Ag Committee, not the Banking Committee in the Senate, said what that will look like will be data reporting, capital requirements, cybersecurity standards, measures to prevent fraud and price manipulation and anti-money laundering, and know your customer protections. That is a sensible package to require from intermediaries in our cryptocurrency space, and it's, I think, the low-hanging fruit from a harmonization standpoint, what Congress can do soon.
Thank you very much, Mr. Chairman.
Gentleman yields back the time. So I would like to thank our witnesses for today. I thought this was illuminating in so many various areas and completely befuddling in others, which welcome to Congress, I guess. But it was very helpful, and thank you for this. I believe that this is probably hello, not goodbye. We are going to be continuing to have this conversation. I do have, without objection, I'd like to submit a following statement. For the record, a statement from Liquid M Capital Incorporated, and without objection, so moved. And without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which I'll then forward on to you all. And just ask our witnesses to please respond as promptly as possible. Without objection, all members will have 5 legislative days within which to submit extraneous materials for the chair for inclusion into the record as well. So again, thank you very much for your time, your attention to this, and your insight. And this hearing is adjourned.
In the questioning, well, I think there was
might have made it more lively.
Yeah, it might have. I mean, there is so much material to cover here, and that's the frustration with the structure that we have of 5-minute questioning, right? You know, you got to move on so quickly. I mean, you could have spent 30 minutes. I could have spent 30 minutes, you know, questioning each one of the witnesses, but that's, you know, this was our first sort of formal conversation that we are having as a committee.
Will there be more?
I hope to, yes, and certainly there will be, whether it's in a committee form or not, there's certainly going to be those conversations going on. But as you saw, you know, Brad Sherman saying, literally, this is like outright scam,
Right.
to Tom Emmer saying, I'm not sure that the government really should have a touch on this at all because this is sort of outside of the proper lanes of government. I mean, there's a lot of divergent, and it mixes up in and among the.
You did not mention the banking regulators.
No,
and where do they have a role or not?
I don't know that they don't have a role. Certainly, I think Treasury is going to have some of that, and I think that was also part of my opening statement, or in my you know, talking about Treasury. I don't know if I specifically mentioned the working group, but I know that we alluded to, you know, Treasury being engaged and involved in this. Certainly, between Treasury, CFTC, SEC, you know, the alphabet soup of regulators are fully engaged. What I haven't seen is a whole lot of coordination on that, and what we haven't identified is who is that lead coordinator. And some of that is frankly our job too, right? I mean, that is the job of oversight that Congress has into all of these things. We've got some jurisdictional issues, you know, between the Ag Committee dealing with futures and the CFTC predominantly, and us dealing with the Securities and Exchange Commission, specifically our subcommittee here. And what is that role? And it gets down to what a significant amount of time was spent on, which is, what is it? You know, is it a cat or is it a dog? Is it security or is it a future? And therefore then how it is defined is very important as to how it's dealt with. And so those are some of the things. That's one of the reasons why we had the hearing today, was to explore some of those things. And as I said, kind of in my final farewell, you know, I think this is hello, not goodbye. This isn't going to be the end of the conversation.
Do you agree with Brad Sherman that it's a scam? Do you think it's
I think by its nature, no. Has it been used to defraud people? Yes. I mean, we know that. We know that there has been problems. I don't believe it was. I don't believe it's invented as a. You know, cryptocurrencies was not invented as a Ponzi scheme. I think there is which distinguishes it differently. I think it is moving towards a real need that some people have identified. Whether it's the efficiencies that are in it, you know, and again, the currency in my mind is a vehicle for the technology of blockchain. That blockchain technology is really the gold here that needs to get mined. And have there been problems? Yes. You know, AML, you know, anti-money laundering, dealing with illicit terrorism financing and those kinds of things. And so now again, this tool has the potential of being used in an illicit fashion.
Okay, but elaborate what you said. It's moving to a real need. Elaborate on that. What's the real need that cryptocurrency is moving to? Elaborate.
Well, again, I think I think what I was saying was the real need on the blockchain technology. You know, having a distributed ledger and that technology. You know, again, the currency is the vehicle that the technology is being brought about. I'm not sure that I agreed with the panelists that, and Mr. Rosenbloom had touched on that about. After he got challenged, I think it was by Mr. Sherman again, or maybe it was Mr. Scott, about sort of, well, do we really need this, right? You know, and clearly Mr. Rosenbloom was arguing yes, and the full 45 seconds or whatever that he was allotted to answer it, and Mr. Sherman was basically, as I interpreted what he was saying, was, hey, no, we don't really need this. We've had third-party intercessors in this already. bank tellers and people that handle actual currency. So no, we don't need that. And I think one of the questions that still wasn't resolved in my mind, but is continues to warrant some exploration and conversation is, okay, how is this different than an Apple Pay or a technology that utilizes a commonly recognized and utilized currency, hard currency, central bank currency, versus creating a cryptocurrency or any kind of fiat currency like that. And that was what I was sort of getting at on the very last question I had was, okay, so ultimately is this going to be fully integrated unless there's some sort of central bank system, whether it's, theoretically it could be Switzerland, and I know Switzerland had sort of looked at that, and I think they backed off. Could it be a smaller non-player now trying to become a player? And we all think of all kinds of, whether it's a tax shelter, Isle of Man type situation, or whether it's somebody in the Middle East or in Asia or in Latin America trying to assert themselves in a way that they haven't traditionally. So.
Can I ask a quick question again? Do you have any other insights on the SEC subpoenas? I know you guys talk a lot with the agencies, so.
Other than they feel the necessity to get information, and to, as I understand it, is really trying to figure out whether there is there fire where the smoke is, right? So.
Do you know which companies?
I don't. I have not. That has not been shared.
When you think about Congress's role going forward, I mean, you kind of alluded to this, but should you guys be thinking about legislation to clarify regulatory responsibilities, how this sector gets approached? What role are you all playing in this right now?
Well, that is your question is should we? The answer to that is yes. I mean, we always need to be exploring that, figuring out where those boundaries are. And as Ted and I were talking, well, that was Ted's original question, which was, and I think that was part of what we wanted to get. And I did not hear consensus as to whether the CFTC's and the SEC's current structure is adequate to address that. So far, I think the regulating agencies believe that it is. You had Mr. Rosenbloom sort of assert that, and that was why I ran through okay, so if they're trying to do their job, you say that they need to change their practices to make sure these ICOs are moving smoothly, but we don't need legislative fix. So, okay, how does that all work?
Why didn't you have one of the regulators here? Why didn't you have anybody from the CFTC or the SEC at the hearing?
Yeah, thank you. Well, we wanted to get this panel out here first, and then we will be having SEC folks. We've got enforcement folks that are supposed to be here on Friday.
Right.
And we're working through all the department heads to have them in, and this will be part of whatever they have. So this was intended to be kind of the users and a little more of the academics and those kinds of things. So all right, thanks. All right.
Make sure you got what you needed to say in there at some point, even if